This is an analysis from Alpha Business Media. In the boardrooms of Kathmandu, there's a number that everyone is talking about. It's a figure that really defines the silent battle being waged right now inside Nepal's financial system. So let's get into it. $2 billion. Now, this isn't a case of missing money or empty bank vaults, not at all. This staggering figure represents a massive liquidity gap. It's a really profound and dangerous disconnect between the capital that exists in the system and the capital that's actually being put to work in the private sector. The very engine of Nepal's growth. To really get this, we first have to be clear on what liquidity means, especially in the Nepalese context. It's not just about having cash on hand. Think of it as the lifeblood of a bank's day-to-day operations. It's fueled by deposits, by remittance inflows, by lending between banks. It's supposed to be this dynamic reservoir funding businesses. But right now, that reservoir is looking more like a stagnant lake. And that brings us to the central paradox of this whole situation. How can a system be totally awash with potential capital while the economy, especially the small and medium-sized businesses, is literally starved of it? This is the core mystery we're going to break down. Let me put it another way. If credit is the lifeblood of an economy, what we're seeing in Nepal is a constriction right at the heart. The capital is there, but it's just not flowing to the businesses that desperately need it to grow, to hire, and to innovate. So the really crucial question is, who's doing the constricting? Well, it turns out the source of this gridlock can be traced directly to the system's most dominant players, the country's major Class A commercial banks. Let's take a look at how this is happening. So instead of giving out new credit lines to, say, a manufacturing firm or an agri-tech startup, these huge banks are deliberately hoarding liquidity. They're parking their extra cash in virtually risk-free government bonds. They're holding on to massive cash buffers, way more than what's legally required. And look, from their perspective, it's a rational strategy. But for the economy, it's calamitous. And it's all driven by one thing: fear. What we're seeing is a fundamental strategic shift. The whole era of aggressive, breakneck growth is, well, it's over. The banks got scarred by a recent spike in bad loans, and so the new mantra in every major boardroom is defense. It's all about preserving the balance sheet, not chasing risky growth. And this quote just brilliantly illustrates the personal incentives that are at play here. For a bank CEO today, the career risk of a rising non-performing loan, or NPL ratio, is absolutely immense. An NPL is basically just a loan that's in default or about to be. A high NPL ratio is a much, much bigger threat to a CEO's job than the little slap on the wrist they might get for failing to meet a government lending target. And that calculation, right there, changes everything. So this sets up a direct confrontation. On one side, you have the central bank pushing for growth. And on the other, you have the commercial banks who are prioritizing safety above all else. It's a classic clash of national ambition versus commercial prudence. This slide just lays the misalignment out perfectly. The central bank is saying, lend to small businesses, fuel the country's growth. But the bank's reality is, protect the balance sheet, minimize our risk. In the current environment, an 8% return on a zero-risk government bond looks a whole lot better than a 13% interest rate on a loan to a small business that just might default. And as a result, those government mandates for lending to priority sectors, they're now viewed as a risk tax. It's not a developmental goal to embrace, it's just another cost to be minimized, or maybe even avoided altogether. In fact, some banks are finding it's actually cheaper to just pay the fine for not complying. But this liquidity hoarding isn't some victimless strategy. It creates a really dangerous ripple effect that threatens the stability of the entire financial ecosystem. And it's especially hitting the smaller Class B and Class C institutions, the very banks that so many local businesses depend on. The first weapon here is the interbank market. When the big Class A banks hoard cash, they stop lending it overnight to smaller banks. You can see the stark difference right on this chart. It drives the cost of short-term funding from its historical low on the left to this prohibitively high rate on the right. It's effectively starving these smaller institutions of essential cash. And this kicks off a vicious cycle. You see, smaller banks are heavily exposed to higher risk sectors like SME and personal loans. So as those loans start to go sour, their NPLs climb. This makes it even harder for them to get funding, which then forces them to stop lending altogether. And that just crushes their profitability. For these banks, this isn't just a challenge, it's an existential threat. So you can see where this is all heading. This trajectory is simply unsustainable. Having a fragmented system with dozens of undercapitalized small banks is just a recipe for systemic fragility. Because of all this, a big wave of consolidation in the banking sector is no longer a choice. It's a looming necessity. Our forecast is that the central bank is going to move from just encouraging mergers to actually mandating them. This timeline, as we see it, gives the market one last chance to sort itself out. But by the fourth quarter of 2026, we fully anticipate a formal, directed consolidation framework that will compel weaker banks to either merge or be acquired. And this is really the hard truth of the whole situation. This process is going to be painful. It will be disruptive for employees, for shareholders, and for the customers of these smaller banks. But it's seen as the necessary price for building a financial system that's actually robust enough to support Nepal's long-term economic ambitions. So for Nepal's business leaders, for its investors, and for policymakers, the writing is on the wall. The era of a fragmented banking sector is ending. The era of managed consolidation is about to begin. The question isn't if anymore, but when and how. And is the country really ready for the painful, necessary price of stability?